When the bottom dropped out of AI stocks last week, one option strategy provided me a $55,000 offset to what would have been a $94,000 loss. It turned what could have been a 12% plunge and a very bad day into just a 5% hiccup. Hey Bowtie Nation, Joseph Hogue here with the power of options investing, not just to boost your returns, but also to protect your hard-earned money and even create income from a stock. Investors are loving options investing with nearly 40 million contracts traded every day. But they're doing it all wrong, losing over $5 billion a year. We'll start with a quick explanation of options and how they can be used to increase your returns, protect your money, and even create income, along with the risks to options investing. I'll then get you started investing in options with 3 strategies every investor should know. At its most basic, options are just an investment that a stock will go up or down within a certain time, as opposed to buying a stock where you own that stock forever and can wait for it to go up. Options have a limited lifespan where you make money or don't. I want to get to those 3 strategies instead of talking through a bunch of lingo because it's the examples later that are going to help you understand everything here and put options investing in your toolbox. Here there are 2 types of options. If you buy a call option, you're paying an amount now called a premium to be able to buy that stock for a certain price, the strike price, until that option expires. If you buy that call option, no matter how high the stock price goes, you've locked in that price. The other type here is called a put option. If you buy a put option, you're paying that premium to be able to sell the stock for that strike price until the option expires. It doesn't matter how far the stock falls. You've locked in that price to sell it, so puts can be a powerful way to protect your downside. You can also sell these options to another investor, collecting that premium instead of paying it. That's one of the ways to turn options investing into a monthly or even weekly stream of income. Selling a call option on shares of NVIDIA here at a $125 strike price will net you $5.45 a share, or a 4.4% cash yield just over 1 month. Of course, the most obvious use of options is that leveraged upside to higher returns. Buying the $125 strike call option on shares of NVIDIA at $5.45 a share, you lock in that price that you pay. If, let's say, NVIDIA jumps to $145 per share before the option expires, the value of that option is going to jump as well to at least $20 each, and selling it would make you a 266% return. But then the most overlooked use of options, the one I use it for most often, is to protect my portfolio. Selling those call options on AMD, Symbotic, and SMCI transferred some of that downside risk to another investor, offset tens of thousands of dollars in potential losses when that DeepSeek sell-off came. But I don't want you to think that options are without risk. Even if some strategies can lower your risk, there are still risks to using these. First is that options expire and you can lose your entire investment. For example, if you buy this February 21st call option on NVIDIA, locking in that $125 per share price, but the stock doesn't make it to that point, then that option expires worthless and you lose what you paid, that $5.45 premium. Now I want to get into those 3 option strategies next, 3 of my favorite, but if you want to see all 29 option strategies, don't miss the relaunch of my Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. Right now, I'm relaunching the course at a 38% discount. Save $150 off. You'll get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much money you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 launch discount is only available with the coupon code in the link I'll leave in the description below. So look for that link or click on the QR code here. Our first strategy is called the Wheel Strategy, easily the most popular option strategy for creating constant income. And it lets me describe 2 separate strategies all in one. In here you start with a stock you wouldn't mind owning or buying more shares and sell a put option at a strike price below the current price. I'm going to walk you through a real life example next, but this starts off by collecting that money without doing anything. You don't even need to buy the stock. Let's go back to our NVIDIA options for an example because it's going to make it so much easier to understand. NVIDIA is the undisputable king of AI, and you wouldn't mind owning the shares, but that 0.03% dividend just isn't rocking your boat. So instead, you sell the put options for a $120 strike price expiring about a month in February. Now understand, the options contracts always trade in blocks of 100 shares, so you're not just collecting that $5.10 per share selling those puts to another investor. You're collecting 100 times that, or $510 for every 100 shares. What all this means though, you're collecting that cash now, but you're committing to buying 100 shares of Nvidia for $120 each if they fall below that through that February 21st expiration. For this strategy then, we're holding back enough cash to buy those shares for that price just in case, so 100 times 120 each be about $12,000 in the account. If Nvidia falls below $120 each, you're going to buy their shares. If the stock stays above that, you don't. Either way though, you're going to keep that $5.10 per share in cash collected, or a dividend over 4% in just 1 month. So if the shares do stay above that $120 each by that February expiration, nothing happens and you can do it all over another month, collecting another 4% plus dividend. If the stock does fall and you buy it for that $120, this is where you start selling those call options against it for more cash flow. Now the premiums would be different here because the price will have changed, but we're going to use this again for our example. Here you might sell the $124 call options and receive $5.90 a share for each of your 100 shares you now own, now collecting almost $600 in cash on the position. If the shares rise to that $124 or over by the end of that next month, the other investor buys them from you for that price. If the shares stay under $124 each, you're going to keep them again, but either way here, you keep that money. And you can continue to sell those call options each month until the stock is called away, each month making 4 to 5% cash yield. You can see how that cash yield adds up too. If you're collecting around $550 a month on a position that cost you $12,000, in 1 year you would have collected $6,600, or a 55% cash return on your money. Now before you rush out to wheel every stock out there, like most strategies, it ain't all rainbows and unicorns. There are risks to each stage in that wheel option strategy. First, if that stock tanks while you've sold the put options, you're still on the hook to buy it for that strike price. Those shares of Nvidia could fall to $115 a share, but you'd still have to buy it for that $120 put option. Then once you own the shares and have sold that call option, you're committed to selling them for that price. So if Nvidia jumps to $130 a share, you could miss out on some of that upside. And it's just the trade-off you have to make, accepting those risks in exchange for that monthly or even weekly income that you can generate on this wheel strategy. We've got 2 more option strategies to get you started, but I also want to talk you through some of the biggest mistakes investors make with options and how to avoid them. First is the shortened time limit on options and the idea of time decay. This is the biggest surprise for most investors because they're so used to just holding the stock and waiting. For options though, that premium you pay to buy those options, so besides the intrinsic value, also has some time value. For example, buying that call option on Nvidia for $5.45 at a strike price of $125 per share, since the current price of the stock is below that option strike price, all of that premium you pay now is in time value, the value of being able to lock in that price for the next month. But as you get closer to that option's expiration, that time value is going to decrease. If the stock price heads higher, then you're still going to make money because the option is going to start having more intrinsic value. But if the price goes nowhere or just falls, the loss of that time value is slowly going to make that option worthless. And that means the biggest mistake most investors make is just not investing with a catalyst in mind. Where investing in a stock is all about the why. Why should that stock price go higher regardless of how long it takes? Investing in options is much more about the when that's going to happen. That means not only do you need an idea of whether the stock price should be higher or lower, but also when that catalyst, when that event might happen that starts the price in that direction. That means part of your analysis needs to be asking yourself, what are the significant events coming up? Is there an earnings release or maybe a product launch by the company? Might there be a change in some bigger picture news like the economy or a tech evolution that benefits this company? Now, this idea of a catalyst is not only going to help you decide how far out you need for that option to expire, but also what strike price and what strategy you need to use. This next option strategy can make you money whether a stock goes up or down. The strap strategy is set up buying 2 call options while also buying 1 put option. This strategy works best when you expect the stock to move a lot. You aren't sure in which direction, but you think it's more likely to move higher than lower. For example, if you expect important news to be coming out on its earnings report that could either sink the company or drive it higher. We'll go back to Nvidia here, the dominant player in that AI chips theme, but extremely volatile lately after that DeepSeek news. And news over the last couple of weeks makes me believe that we're still going to see that massive capital spending into chips this year, but this stock is still going to be extremely risky around each earnings report. With the AI theme just getting started, the stock could surge back to its $153 peak or fall even further. The only thing I do know is the stock is going to move big time one way or the other. And that's where the strap option strategy comes in, allowing me to profit whether the stock price moves higher or lower but with a bigger profit in the upside. With NVIDIA reporting earnings February 26th, we can use the March 21st options to capture that event. I'd buy 2 call options at $122 strike price, as well as buying 1 put at that same strike. Here it's going to cost me $11.45 each, or $22.90 total for those call options, plus the $9.92 each for the puts. In all, I'm spending just over $32.80 for each share times 100 shares for a $3,282 investment. And here you can see the payoff in the options calculator from the course. If the shares of NVIDIA jump beyond $138 each, you start making money and can make a lot of money the higher it goes. Back at the $153 peak and you've made $3,000 or nearly a 100% return. But the beauty here is, even if the stock crashes, you can still make money. A bad earnings report or more DeepSeek news that sends NVIDIA plunging, and you're going to make money on this. This next option strategy is going to help you get your money back fast on a losing stock, even if it doesn't rebound. But investing is so much easier when you find the best stocks. That's why I put together the video in the corner here, the 7 stocks I'm buying this year for triple-digit returns. So be sure to check that out next. Here, if you've ever been so far down on a stock that you just want to make your money back, this next option strategy, the stock repair strategy, is perfect. Not only will it help you make your money back on a losing stock, but even turn a profit, even if the stock price doesn't jump higher. I know the graph here looks a little confusing, but I'll walk you through an example. Assuming you already own the stock, you'd set this up buying a call option and then selling 2 calls at a higher strike for every 100 shares you own. And in the example, I'll show you how this gradually lowers your cost in the stock even if the price doesn't rebound, and then makes your money back fast with just a small bump in the shares. Let's say you're down on some shares of NVIDIA that you bought at $142 each the day before that damned DeepSeek news. You're down about 13% even after the rebound and worried that it might have further to fall, and just want to make your money back and get out. So remember, for the stock repair strategy, we're going to be buying 1 call option and selling 2 calls for that higher strike for every 100 shares we own. We'll use those March options again, and I'll buy 1 call at $125 strike price. That's going to cost me $9.95 each. But then I'll also sell 2 call options at the $130 strike price, collecting $8 each, or $16 total. Now that means netted out, collecting the $16 and paying the $9.95. I will be collecting cash of $6.05 for every share I own. So here you see I've already lowered my cost basis from that original $142 each by that $6 that I'm collecting. The shares could go nowhere and I've already gotten some of my money back. But then the payoff chart shows how this works to make your money back fast. Collecting that $6 each lowers your original cost, so even if the stock doesn't rebound further, you can repeat the strategy after those options expire and lower your cost further, eventually making all your money back. If the shares of NVIDIA do rebound though, those call options you bought were totally paid for, and they start making your money back fast. Here you can see even if the stock stays at $123 each, you start making money, and if it rises to $135, you've made all your money back and then some. Get your $150 discount and see those 29 option strategies, along with the strategy finder and the options calculator, only with the coupon code in the description below. Or click on the video to the right to see the 7 stocks I'm buying for 100% returns this year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.